Here with us now on set, Gabriela Santos, global market strategist at JPMorgan Asset Management. Good morning to you.
Good morning.
We're going to be talking to Lee Cooperman a little bit later, and he has a view that I don't want to tell you that his view is negative on everything, but broadly speaking, thinks that equities right now I think are overvalued. Generally speaking, you in the same category?
So I think in terms of our macro view, it's actually improved significantly since the end of May, and we now think the probability is higher for a soft landing. We've also gotten much better earnings data, and actually earnings estimates have moved up 4 percentage points. That doesn't neatly translate into a buy U.S. large cap stocks view because of valuations. And especially because of the contribution of these top 10 stocks, which are now 30% of the index and are at 145% of normal valuations, which is really pulling up the whole index valuation at over 18 times. So if you just take a market cap approach from here, we do think we'll have mid-single digit returns annualized from here. So much more our approach is to either think about an equal weight investing or even more than that, just to take a very, very active approach at all subsectors, to think carefully about valuations and to still think carefully about quality.
How are you guys thinking about China right now? And the reason I ask is this big Apple news, I think, is a big risk in the market, not just to Apple longer term, but to every American firm that does business in China, because there seemed to have been a view that somehow the risk was off the table, that if an Apple has so many employees and people doing business in China through Foxconn and other things, that somehow they would be untouched. But has this changed?
I think there's been building for a few years now this much more buy Chinese sentiment within China. And I think this is a symbol of where we're moving when it comes to trying to access the Chinese consumer, the second largest contributor to global consumption. From here on out, it's going to get harder and harder to do that indirectly through multinational companies, U.S. companies especially, but also European companies.
But do you want to be in those companies, given that it's possible if you cut off, what do we say? It's a fifth of Apple's revenue?
Yeah.
Right. If you cut off that, and I don't know, I'm not suggesting that's happening overnight, but if you sort of take this to its ultimate place, that's what happens.
And exactly, we don't think that there will be an overnight cutoff, just if we think about how much consumers have grown to enjoy certain of these products, as well as the employment that some of these companies,
that's the question,
such as Apple,
how do you measure that risk? How do you look at a Disney that has a park in Shanghai? Could you ever imagine a day where they're like, no, we're not doing it this way anymore?
So we think that complete cutoff is not where we're going. We do think over time there will be a migration from Chinese consumption of foreign multinational consumer brands towards much more domestic champions. And so when we think about what we actually want to invest in China, it still is the Chinese consumer. We don't think that story is over because we've gotten some disappointment in the recovery this year. But to do that, we need to be investing in the new Chinese domestic champions, consumer discretionary, consumer staples, healthcare. And by the way, these are companies that are much more attuned to the change in consumption patterns in China to begin with, and have been tapping into that much more over the past few years.